Make no mistake, that is not the GDP of a sovereign nation. That is the implied volatility that Wall Street has to digest the moment the opening bell rings. Global liquidity trends have effectively decoupled from the Federal Reserve's interest rate path or the White House's policy agenda. Instead, the market is being held hostage by a single ticker symbol. We are essentially taking the entire market capitalization of three Intels, shoving them onto the table, and placing a binary bet. This is the macroeconomic reality of the week, NVIDIA earnings day. Let's reframe your mental model. This isn't just a quarterly earnings sheet. This is a systemic stress test for the artificial intelligence asset bubble. Current valuation multiples have stretched liquidity to its absolute limit. And this report? It is the potential catalyst for mean reversion. Today, we are going to dissect this $600 billion source of volatility through a valuation model. But this isn't about math, it's about market structure. We are going to filter out the noise and assess risk exposure like an institutional trader. In a casino dominated by high-frequency algorithms, the only rule for survival is this: execute an effective exit strategy. First, take a step back and assess the sentiment indicators. Bullish sentiment has entered a phase of irrational exuberance. When retail traders in Manhattan and the degens on Reddit's Wall Street bets are all crowding into the same trade, that is a classic signal of an overcrowded trade. Why is this lethal? Because it triggers Wall Street's most brutal pricing law: priced for perfection. To explain this in quantitative terms, over the past year, NVIDIA hasn't just beaten expectations, it has reshaped the benchmark. Now, buy-side analysts are incredibly demanding. Simply beating earnings per share, EPS, is not enough. The market has already priced in the most optimistic scenario for the next 3 years: infinite total addressable market, TAM, flawless execution, and zero competition. In finance, we look at the second derivative of growth acceleration. The market is no longer looking at absolute profit figures, it is watching to see if the rate of acceleration is slowing down. Think of it like driving a Ferrari on the highway. 200 miles per hour is the baseline expectation. But if your acceleration drops even slightly, even if you are still speeding up, the algorithmic bots will execute an immediate sell-off. If NVIDIA hints that growth is 1% slower than last quarter at these multiples, that triggers a disastrous re-rating of the stock. The margin for error is zero. Let's dive into the fundamentals. Let's talk capital expenditure, CAPEX. The current AI boom is essentially an arms race between Silicon Valley's Big Four, Microsoft, Google, Meta, and Amazon. These companies are trapped in a game theory scenario known as the prisoner's dilemma. If you are Google CEO Sundar Pichai, do you know that the current return on investment for AI is negative? Of course. Current revenue streams cannot cover the infrastructure costs. Do you want to cut capex? Absolutely. Your CFO is warning you about cash flow pressure every day. But you can't stop, because if Satya Nadella at Microsoft continues to stack computing power, Bing could algorithmically surpass you and dismantle your search moat. This is defensive spending purely for survival. Therefore, even in the face of margin compression, they are forced to transfer hundreds of billions of dollars annually onto NVIDIA's balance sheet to buy expensive H100 and Blackwell GPUs. NVIDIA, as the monopoly supplier of shovels in this gold rush, enjoys the premium. However, there is a macro math problem here. Sequoia Capital has already sounded the alarm. Look at this core data point. To justify this hardware capex, the AI industry must generate approximately $600 billion in incremental revenue annually. Note that figure, $600 billion, but reality is disconnected. If you sum up all global AI software subscriptions and API revenues, it amounts to only a few tens of billions. There is a revenue gap of over $500 billion. It's like investing $1 million to build a restaurant, but your daily cash flow is only enough to sell a few hot dogs. This is a valuation bubble. Buying now is based on discounting the future, driven by a capex cycle fueled by fear. The giants fear falling behind. Retail investors fear missing out. FOMO. But the risk is that this fear is unsustainable. Once Wall Street demands to see free cash flow conversion, if just one giant, say, Meta, decides to cut next year's capex guidance, NVIDIA's order book faces default risk. This is the systemic risk of excessive customer concentration. Beyond the commercial logic, NVIDIA faces two specific tail risks. First is the physical bottleneck. All eyes are on the latest Blackwell architecture. This is their core moat. But supply chain intelligence suggests thermal design power issues. The heat generated by these chips at rack density is causing overheating risks. This isn't a simple assembly issue. If the cooling solution isn't perfect, it means redesigns and delivery delays. In tech, time to market is everything. If they are delayed by 3 months, AMD gets a window of opportunity. This would directly hit NVIDIA's high gross margins. Once margins revert to the mean, the valuation model collapses. The second headwind is geopolitical risk from Washington. We're on the eve of the Trump 2 era. Investors must price in macro policy risks, tariffs, and protectionism. NVIDIA's supply chain is highly globalized, designed in California, manufactured by TSMC in Taiwan. If trade barriers escalate, or if new export controls are implemented for national security reasons, this cuts off critical revenue sources. This is an asymmetric policy risk that a candlestick chart cannot predict. Hearing this, your risk aversion might be spiking. You might be considering liquidating everything and sitting on cash. No, that is not the professional approach. In financial markets, volatility equals opportunity. You need risk management, not panic. Here is the institutional grade playbook. Rule number 1. Avoid the gamma squeeze. Do not gamble on options before earnings. Absolutely not. The get-rich-quick stories on Reddit are survivor bias. During earnings season, NVIDIA's implied volatility is sky high. The market has already priced in a massive move. To profit, the stock must move even more violently than expected. Even if the earnings are good and the stock rises 5%, if it doesn't meet the implied volatility expectation, you will still lose money due to IV crush. Do not try to pick up pennies in front of a steamroller. Rule number 2. The core satellite strategy. This is standard hedge fund configuration. Allocate 80% of your funds to core assets, the S&P 500 or NASDAQ 100. This is your beta return. If NVIDIA rallies, the index benefits. If it crashes, the diversification protects your principal. Use the remaining 20% of risk capital as a satellite to chase alpha. Buy NVIDIA stock directly or a semiconductor ETF. This is an asymmetric bet, limiting downside risk while retaining upside explosive power. Rule number 3. Hedge via utilities. If you think tech valuations are too high, look for second-order beneficiaries. No matter who wins the AI model war, one thing is certain. AI is a massive energy consumer. Future data centers are essentially power plants with computing capabilities attached. Go long on power infrastructure. Look at utilities and nuclear sectors. Companies like Vistra Energy or Constellation Energy, these offer high certainty. In a gold rush, the steadiest strategy is selling water. And in the AI era, electricity is water. Rule number 4. Strictly execute a trailing stop. If you hold NVIDIA and have floating profits, congratulations. But don't let greed take the wheel. Set a trailing stop. No one can predict the top, not even Jensen Huang. Set a 10% or 15% pullback trigger. If the price retraces 15% from its high, let the algorithm execute the sell automatically. This way, you capture the upside beta while locking in profits. Don't fall in love with the stock. Use technical tools to eliminate emotion and prevent a huge gain from turning into a loss. Finally, let's talk about market psychology. Staring at the ticker tape, we are prone to FOMO. But remember the lessons of historical cycles. Cisco Systems in the year 2000 was that era's NVIDIA. It was the king of internet infrastructure, the most valuable company in the world. The result? After the bubble burst, it fell 80%. Even though it remained a great company, It took 20 years for the stock price to return to its highs. If you buy at the peak of a valuation bubble, the cost of time is immense. Great companies do not always equal great stocks, especially when the price has already overdrafted the next 10 years of cash flow. In this market full of noise and algorithmic warfare, your most valuable assets are discipline and patience. Block out the emotions, trust the data. In this feast of liquidity, only those who keep one eye on the exit can keep their winnings when the music stops. That is the trading strategy for this week. Remember, capital preservation is the prerequisite for a comeback. Good luck!